Welcome to This Explainer. Think of me as your personal financial mentor today. Today, we are going to totally bypass the usual myths and get straight to the exact data-backed blueprint for turning your early career paychecks into serious, lasting wealth. Let's kick things off with a question, one that basically draws a hard line between an employee mindset and a wealth creator mindset. Do you know the exact price of your daily habits? Seriously, most people don't. They kind of just let money slip through their fingers, completely unaware of the exponential potential hiding in their everyday choices. Well, today, we're changing that. So here's our game plan. We'll be covering the everyday millionaire next door, shifting to value-based pricing, automating your wealth engine, mastering debt and compounding, the power of consistent habits, and finally, your step-by-step wealth checklist. All right, let's jump right into section 1, the everyday millionaire next door. Now, this is fascinating. Roughly 1 in 10 US households has $1 million net worth. That's about 12 million families. But look closely at the breakdown here. You've got 3.7% tied up in home equity, so they're illiquid. 3.3% are retirement-only millionaires, and a tiny, almost microscopic 3% actually have that wealth in liquid cash and investments. The big takeaway? True wealth is usually quiet. It's hidden in plain sight, probably behind the door of a modest house with a 10-year-old minivan sitting out front. Moving right along to section 2, shift to value-based pricing. Listen, as a young professional, your absolute biggest leap forward is going to come from changing how you view your time. You've got to stop trading your precious hours for a standard flat wage. That employee mindset, it's a one-way ticket to burnout because, well, your time is capped. Instead, you have to start charging for the predictable, valuable outcomes you deliver. Imagine you're a salaried engineer, right? You spend a rainy weekend coding an app that cuts production time by 5 seconds. Instead of just logging a few hours of overtime, you license that tool to your employer for a lump sum. Or say you're a designer quoting a flat rate for a brochure. You use your own hidden keyboard shortcuts and you finish it in half the time. The emotional benefits here are massive. You reclaim your freedom, you ditch the stress of the ticking clock, and you finally price your true value rather than just your time. And that leads perfectly to this quote. Pricing your skills as outcome-based offers is literally the first major lever high earners pull. It completely shatters that psychological link between your time and their income. Once you get that first yes on a flat fee project, it flips a mental switch that you just can't turn off. You're suddenly free to scale your wealth rapidly without sacrificing your entire life. Okay, section 3, automate your wealth engine. I know Wall Street loves to throw around complex jargon just to sound smart, but let's break it down. An index fund is basically just a broad, boring, low-cost bucket of the world's best companies. You hold it for decades, not months. The data actually shows that since 1970, a global basket of stocks has literally never produced a negative return over any 20-year window. Never. But research finds average investors capture barely half of those market returns because they panic and jump in and out based on news headlines. The wealthy, though, they just set it, let it ride, reinvest the dividends, and go mow the lawn. Just look at how daily micro-saving habits stack up over time. Say you brew coffee at home for 40 cents instead of dropping $3 on a to-go cup. That simple choice saves you $950 a year. Now, if you invest that money at an 8% return for 20 years, that coffee money alone becomes $45,000. And look at the base investment of $16 and change a day. That grows into nearly $300,000. It's not about punishing yourself, it's just recognizing the future value of a dollar and putting your wealth on autopilot. Take Mia, for example. She's a dental assistant who proved this works by starting with just $50 a week. Every January, she nudged it up by just $10. Fast forward 5 years, and she was saving 25% of her take-home pay with almost no pain. Automation completely beats willpower. It works because you take today's move completely out of the equation, and you treat wealth creation like it's a non-negotiable built-in bill. Which brings us to section 4, master debt and compounding. 19%. Carrying a credit card balance with a 19% APR is like swimming in financial quicksand. It will effortlessly devour those 8% market gains you worked so hard to build. Roughly 3/4 of millionaires have never carried a credit card bill past the due date. They get it. High interest is literally just the compounding effect working against you. But hey, the wealthy aren't universally terrified of debt. Check out this comparison. Toxic debt sabotages you, sure, but strategic debt? That's a lever. The golden rule for any loan is simply asking, will this reliably put more money in my pocket than it takes out? Picture buying a duplex with a fixed 6% mortgage. If the rent from the second unit covers your principal, interest, insurance, repairs, and still leaves you with a $150 surplus every month, well, suddenly debt isn't a compounding black hole anymore. It's a powerful lever pushing you forward. Let's roll into Section 5, the power of consistent habits. I absolutely love this timeline. It follows Linda, a postal worker who didn't even start really focusing on this until she was 45. By 45, she had $30,000 saved. By 55, it grew to $300,000. By 60, $750,000. And by age 65, her retirement accounts crossed the $1.05 million mark. This right here proves that steady discipline and patience completely obliterate short-term market timing. You don't need to be a Wall Street whiz, you just have to be consistent. So how exactly did Linda pull this off without a massive corporate salary? She kept her habits simple and minimal time. She automated 10% of her income right off the top. She started a low-risk side hustle selling handmade soap online. She ruthlessly slashed her subscription clutter. And here's the absolute game changer. Every single time she got a raise, she applied it directly to her investment draft. Her whole mantra was just set it, forget it, add to it. She let exponential growth do the heavy lifting. And this chart really drives home that profound respect for the clock. Look at this difference. Someone who invests $6,000 a year for just a 10-year window in their 20s and then completely stops will often end up significantly richer than someone who starts at age 40 and saves aggressively every single year straight into retirement. That's the miracle of exponential growth. The best time to start was yesterday, but the second best time is right now. Finally, Section 6, your step-by-step wealth checklist. Let's turn all of this into a smooth, minimal-time routine for you. Follow these simple steps starting tonight to shift from a spending-focused employee into an outcome-focused wealth creator. Keep this checklist handy to track your monthly progress. First, sketch out your personal finish line using an online calculator so you know your target. Second, hunt down one recurring bill you don't need. Kill it and reroute those funds to an auto-draft investment. Third, flip that mental switch and send out one outcome-based pitch for your skills this week. And fourth, guard your engine by systematically knocking out that high-interest debt to build a solid 3-month emergency fund. Your future vault is right there, waiting behind an ordinary door, and you've literally got the key in your hand. The gap between lasting wealth and financial struggle isn't luck, guys. It's routine. Thank you so much for joining me in this explainer today. So the only question left to ask is, which routine are you willing to lock in before you go to sleep tonight?